But today, what I want to discuss is there's some pretty big, if you've bought a farm in the last 10 years, you could be sitting on some pretty big tax savings. So when you buy a farm, all the assets that come with the farm, all the sheds, silos, the fencing, they're all lumped together on the contract of sale with the land. So there's just that one number that's there, and whilst it's there like that, your accountant can't do anything. What we do is we go in and measure, photograph everything, then our quantity surveyor, and that's who the ATO deems to be the experts for this, quantity surveyors, puts a value on all these infrastructure and then puts it into a depreciation schedule that your accountant can then use in your profit and loss to reduce your taxable income. And I always find the best way to do this is to take you on a bit of a road trip around a farm, because if I talk about sheds to you, someone will be thinking of a big shiny shed and someone might be thinking of this little one down the back that he's going, surely this is no value left on this. So we'll go for a quick farm tour. This one's down in the Riverina. So first of all, there's the houses that are on the farm. So depending on how you set up, you may be able to claim the houses. And the depreciation on the houses, there's two parts. There's the building component. So that's the outside, the slab, electrical, plumbing work. That's one part. So with that, you can only claim it if it's been built or renovated or extended after 1985. So this sort of all came in around capital gains tax time. So anything before that, you can't claim that part. If it was built before 85 and there has been no extension, you can't claim that part of the house. But there is the inside part of the house which falls under what they call plant and equipment for houses, and it's section 40, and you can still, even if it was installed before 85, you can claim it. And so that's your ovens, cooktops, dishwashers, curtains, blinds, your carpets, vinyl, air conditioning units, fans, light fittings, all that, hot water systems. So all that, we can put a value on that, and that can be put into the depreciation schedule. But where the big numbers generally fall on these reports is when we're going around the farm. So you've got your shiny sheds, but it is surprising how much you get a number of the smaller sheds, how it starts adding up in value. So whilst I'm walking you around, I want you to have a think about, at the end, I'm going to ask what you think all this comes to in terms of value. So there's pump sheds, there's always shearing sheds, chemical sheds, even the old garage that the utes in. Hay sheds, I normally have to prompt people and make sure there's no hay shed hidden down the back that they haven't told me about, because again, there could be a bit of value there, or silos. Your sheep yards and your cattle yards. Dog yards, I think it's going a bit too far if it's the 44-gallon drum on its side. And I just did some farms at Warrior a couple of days ago, and it was the 1,000-litre shuttle with a hole cut out. I don't think I can do those. Silos, even these flat bottom ones that people hate, there is value in them. It just, all this adds up. Your ramps, I did a farm at Grenfell a few weeks ago, and this guy mustn't have liked open gates because there was about 14 or 15 ramps right through the middle of the farm, so he didn't have to open any gates. Your loading ramps. Remember, in your shearing shed, a lot of times the shearing planters come with the sale. Your wool bins, your wool table, and then fences. It's depending on where you are, the amount of fencing starts adding up. On this place, there was 30 kilometres. Gates, I always find gates funny, only because I'll ask, as we're driving around, the client to start thinking about how many gates are on the farm, and they'll go, oh, there's 40. Yep, and we'll be driving, and then we'll get to 2 more paddocks. Hang on, there's 2 up around the haystack, and then there's another 4, and we'll end up with another 20 before we finish. But so gates add up. And then all people forget about fuel tanks that have come with the farm as well. So that was a farm I did in the Riverina. 30 kilometres of fencing, 70 gates. Anyone want to shout out a number on what they think, how much depreciation there could be? Any number?
10 grand.
Gosh, you won't get a job with me, will you? Anyone else? I need one more number before I go.
200.
200, very good. 594,000. So all that added up to be 594,000. So normally they would claim that much in the first year because it's all depreciating over the effective life. But in this actual case, if you buy a farm between the 12th of May 2015 and it ends at the end of June, in this case their accountant had them said they were eligible for accelerated depreciation on fencing and fodder storage. So it was actually over 200,000 that they were able to claim. Because it was over, I think it was over 100,000 in fencing. So there was over 200,000 that they were claiming in the first year. So they were pretty happy. Now the next question I get asked is, well, how little enough stuff is there to make it warrant? So we'll have a quick look at this farm. Again, down the Riverina, all there was two little barns like this, and then the rest was fencing. I'm lucky we didn't have to go too far because it was pretty wet. That was when there was water everywhere. And 30 gates. So there was 25 kilometres of fencing and 30 gates. And he ended up with $123,000 in depreciation. And he only bought this in February last year. Accountant said he was eligible for accelerated depreciation, so he was actually getting 117 of that was the fencing, so he's getting all that in the first year. So it adds up. So what you're doing here is no different to you buy a tractor brand new for 400,000, you keep it for 12 years, you've fully depreciated that tractor, you sell it to your neighbour for 100, he starts depreciating it from 100. This is what you're doing. You're buying something, there's still value in those assets. Quantity surveyor is putting a value on it and then you can depreciate it from there. So then another question I will get is, well, how far back can I go to make sure it's worthwhile? Because depreciation starts the day you settle on the farm. And the accountants can generally go back and amend 2 tax years, and depending on your entity, sometimes they can go 4. So I've got an example here. This was actually an accountant I did the farm for. I only did this about a month ago, down around Mudgee. Total depreciation for this farm was $690,000. He hadn't lodged his 15-16, so he was going to collect this $18,000. I don't know whether he was going back 2 or 4 years. So for this example, I thought, well, let's just do 2. Let's say he was going back 2. So with the 2, he could amend, and what he was picking up there was $57,000 in depreciation he was getting straight away. Admittedly, he's going to miss this, which added up to be 211, but he's still got 478,000 that he's going to claim. So even though he bought it back in 03 and is missing out on this bit, it's still heaps of tax savings for him. And so what I do, generally, we've got a checklist that I take people through, and with that I can ascertain if there's going to be enough assets for them to do it. And when I've got to do one now for an accountant at Warwick who has a client, I'm not too sure, it's way at the back of Queensland somewhere, but they bought this farm in 1999, so I've just got to ascertain if there's enough infrastructure there, because they're going to miss the first X amount of years to still warrant them to capture what's left. So any questions I can cover?
What's the catch at the other end? Does it mean if you sell up you've got more capital gains tax to pay?
Yep, you're right. So say that example I gave you, say that farm was worth $2.5 million, and let's say he keeps it for 40 years and he claims the whole 500,000. So you're right, for capital gains purposes, it then starts at 2 million, not 2.5. But every accountant that gets us to do this, they say there's so many things that they can do when you're selling to reduce capital gains that they prefer to get the tax advantage now.
Did you say that it's only that scheme of accelerated depreciation ends?
Yeah, so they did date it when they brought it out, and this last budget, they haven't announced whether they were going to extend it or not. So we're still waiting to see, but if it does, if they don't extend it, then... So that's really going to be just for farms bought from between 12th of May 2015 up until end of this month. So all the depreciation... The difference it means is, say, you're writing fencing off 100% of the fencing in year one versus over at 6.6% over 30 years.
Is this likely to get shut down by the ATO?
This isn't new. If you buy an investment property in a city, a residential investment or commercial property, the first thing your accountant will say is get a depreciation schedule done. It's been happening for a long time. It's just, I suppose, being missed in agriculture. I find I'm probably driving up and down the road, the states, educating accountants, because really agriculture's gone like this. You farmers, you've been making money, then you're losing, then you're making, so you use up those losses, then you're lost again. But we've just gone through this period of 4 or 5 years now where commodity prices have been great, all past losses are being used up, and look, when I sit down in front of an accountant and take them through it, you can see in their eyes they've just gone, I've missed this, they forgot all about it for farming.